Okay, today we will have new topic for the second meeting, that is financial statement analysis. After studying chapter 2, you should be able to understand the purposes of basic financial statements and their contents, explain why financial statement analysis is important to the firm and to outside suppliers of capital, define, calculate, and categorize according to liquidity, financial leverage, coverage, activity, and profitability. The measure financial ratios and understand what they can tell us about the firm. Define, calculate, and discuss a firm's operating cycle and cash cycle. And then use ratios to analyze a firm's health and then recommend reasonable alternative courses of action to improve the health of the firm. Analyze a firm return on investment and return on equity using a Pont Approach, and then understand the limitation of financial ratio analysis, and finally use trend analysis, common sense analysis, and index analysis to gain additional insights into a firm performance. This is the subtopic for today about financial statement, a possible framework for analysis, balance sheet ratio, income statement and income statement, balance sheet ratios, trend analysis, common sense, and index analysis. Okay, we move to the next. What is the examples of external use of statement analysis or financial statement analysis? There are some parties. First of all, for trade creditors, the use of financial statement analysis focus on the liquidity of the firm. And then bondholders also use financial analysis. It's focused on the long-term cash flow of the firm. Shareholders also use financial statement analysis, focus on the profitability and long-term health of the firm. This is the external uses. And how about internal uses? Example of internal uses of statement analysis. First one is planning. Focus on assessing the current financial position and evaluating potential firm opportunities. The second one is for controlling. Focus on return on investment for various assets and asset efficiency. And the next, to understand. Focus on understanding how suppliers of funds analyze the firm. Okay, now we move to the primary types of financial statement. First one, balance sheet. I know that you have learned about balance sheet. Balance sheet is a summary of a firm's financial position on a given date that shows total assets equal total liabilities plus owner's equity. The next financial statement types, income statement. Income statement is a summary of a firm's revenues and expenses over a specified period, ending with net income or loss for the period. So for balance sheets, yeah, we usually call it neraca. Income statement is laporan laba rugi. This is just the example of balance sheet. Now this is the explanation. For example, cash. Cash is how the firm stand on a specific date. Sorry, this one A. Basket Wonders balance sheet. This is the explanation how the firm stand on a specific date. Yeah, what BW on BW it's Basket Wonders, yeah, and etc. You can read all the information here. BC, yeah, total asset. Okay, this one, for example, amounts owed by customer is called account receivable, yeah, and etc. The concept of balance sheet is here. The primary concept, asset is equal liabilities plus equity. Yeah. This one is liability, this one is equity, and for this one is asset. Okay, next. This one is the example of income statement of Basket Wonders. This is the explanation as well. Okay, now we are talking about framework for a financial analysis. First of all, analysis of the funds need of the firm. Jadi berapa banyak dana yang dibutuhkan. Trend or seasonal component, how much funding will be required in the future? Is there a seasonal component? Yeah, this is the question that need to be answered. Analytical tools used, source and usage statement. Laporan, sumber dan penggunaan, ya, dana. Statement of cash flow, laporan rilis kas, cash budget, budget kas, ya, atau penganggaran kas. The second, analysis of the financial condition and profitability of the firm. It's related to health of a firm. So we use financial ratio that can be used individually, over time, in combination, or in comparison. And then analysis of the business risk of the firm. Business risk relates to the risk inherent in the operation of the firm. Some examples: volatility in sales, volatility in cost, proximity to break-even point. Now the three here is determining the financing needs of the firm. Then a financial manager must consider all three jointly. This one, 2, 3, when determining the financing needs of the firm. Negotiation also important with suppliers or capital. Use of financial ratio. Now you just recall what you have learned about financial ratio. A financial ratio is an index that relates to accounting numbers and is obtained by dividing one number by the others. There are two types of comparison: internal comparison and external comparison. Now we move to external comparisons and sources of industry ratio. For external comparisons involves comparing the ratios of one firm with those of similar firms or with industry average. Jadi dibandingkan dengan perusahaan yang sejenis ya atau dengan rata-rata industri. Nah, similarity is important as one should compare apples to apples. For example, in Indonesia, ya Telkom, PT Telkom, ya with the same telecommunication company, ya. Now we move to liquidity ratio. For liquidity ratio, it shows a firm's ability to cover its current liabilities with its current asset. So the formula is current asset per current liabilities. This just example for BW in December 2007. Liquidity ratio is 2.39. If we use liquidity ratio comparison, so compare it with this one is in this industry average. For example, BW is 2.39 and the industry average is 2.15. So it means ratio is stronger than the industry average. So BW is the ratio of BW, our liquidity ratio, is better than industry average. Now we move to liquidity ratio. Liquidity ratio shows a firm's ability to meet current liabilities with its most liquid assets. This is the formula. Current asset minus inventory per current liabilities. This is also almost the same, the example. The same example like this. So for this one, BW is lower, the liquidity ratio, asset test ratio is lower than industry average, so ratio is weaker. This is the example of summary of the liquidity ratio comparison. Current ratio 2.39, industry 2.15. For asset test ratio, BW is 1, and for industry average is 1.25. Strong current ratio and weak asset test ratio indicates a potential problem in the inventories account. Note that this industry has a relatively high level of inventories. This just the trend analysis comparison. For trend analysis, it should be more than 1 year. Actually, at least 3 years ya. Jadi untuk bisa tahu trennya itu ya harus lebih dari 1 tahun, paling tidak itu 3 tahun. Semakin banyak tahun ya, it's better. Okay, this one is summary of the liquidity trend analysis. The current ratio for BW has been rising. At the same time, the asset test ratio has been declining. The current ratio for the industry has been rising slowly. At the same time, the asset ratio has been relatively stable. This indicates that inventories are a significant problem for BW. Okay, now we move to financial leverage ratio. It shows the extent to which the firm is financed by debt. So this is the formula: total debt per shareholders' equity. This is just the example. And this one, financial leverage ratio comparison, is the same, right? Relatively the same. Okay. For financial leverage ratio, we also use this formula. So it shows the relative importance of long-term debt to the long-term financing of the firm. The formula is long-term debt per total capitalization. And total capitalization is long-term debt plus equity. Okay, coverage ratios indicates a firm ability to cover interest charges. Interest charge for the formula, interest coverage is EBIT per interest charge. This is an example of trend analysis of interest coverage ratio. And the summary of the coverage trend analysis. The interest coverage ratio for BW has been falling since 2005. It has been below industry average for the past 2 years. This indicates that low earning or earned before interest and tax may be a potential problem for BW. Note that we know that debt levels are in line with the industry average. Now we move to activity ratios. Activity ratios indicates quality of receivable and how successful the firm is in its collection. Receivable turnover, the formula is annual net credit sales per receivable. And then the other variable for activity ratio is average collection period. The formula is days in the year per receivable turnover. Average collection period is average number of days that receivables are outstanding. Okay, this activity ratio comparison in 2007. Average collection period of BW is 65, and then for average industry is 65.7. BW has improved the average collection from 80-30 to 65. Yeah, average collection period to that the industry average. So it's better, yeah, from 83 to 65. Okay, it's still related to activity ratios. There is payable turnover or PT. The formula is annual credit purchases per account payable. Payable turnover indicates the promptness of payment to supplier by the firm. Payable turnover in days. The formula is days in the year per payable turnover. Payable turnover in days is average number of days that payables are outstanding. Now this one is activity ratio comparison. Payable turnover in days in 2007 for VW is 22.1 and for industry average is 46.7. BW has improved the payable turnover in days from 43.5 to 22.1. Is this good? Hmm. What is your opinion? Yeah, I think it's better, yeah. Because if the payable turnover in this is shorter, means that company can was it can get their cash and can buy uh, more goods, yeah, for yeah, can buy more goods, yeah. Okay, now we move to inventory turnover. Cost of goods sold per inventory. That's the formula. Inventory turnover, it indicates the effectiveness of the inventory management practices of the firm. This one activity ratio comparison, inventory turnover ratio. In year 2007, the inventory turnover ratio for BW is 2.30 and for the industry average is 3.45. It means that BW has a very poor inventory turnover ratio. It's still related to activity ratio, total asset turnover. The formula is not net sales per total assets. It indicates the overall effectiveness of the firm in utilizing its asset to generate sales. Okay, now we move to profitability ratio. For profitability ratio, the data is come from income statement or balance sheet ratios. The component of profitability ratio, first of all, gross profit margin. The formula is gross profit per net sales. Gross profit margin indicates the efficiency of operation and firm pricing policies. For example, Basket Wonders in December 31, 2007 has gross profit margin 0.277 or 27.7%. And for the industry average is 31.1%. So BW has a weak gross profit margin. Now net profit margin. For net profit margin, the formula is net profit after tax per net sales. Net profit margin indicates the firm's profitability after taking account of all expenses and income taxes. Based on this data, BW has a poor net profit margin, lower than industry average. And then return on investment, the formula is net profit after tax per total assets. Return on investment indicates the profitability on the assets of the firm after all expenses and taxes. BW has a poor return on investment is lower than industry average. Return on equity is still related to profitability ratios. For return on equity, the formula is net profit after taxes per shareholders' equity. Return on equity indicates the profitability to the shareholders of the firm after all expenses and taxes. Based on this data, BW has a poor return equity is lower than industry average. And then it's declined from 2005 to 2007. Return on investment and the Pont Approach. For earning power is equal sales profitability multiple asset efficiency. Return on investment is net profit margin multiple total asset turnover. So ROI in 2007 is 0.041 multiple 1.2.02. It's 4.2%, and for ROI industry is 9.8%. So return on investment industry is better than BW, or return on investment BW is lower than industry average. Okay, now we move to return on equity and the DuPont approach. For return on equity, the formula is net profit margin multiple total asset turnover multiple equity multiplier. And the formula for equity multiplier is total asset per shareholders' equity. Based on this formula, the ROE for 2007 is 0.080 or 8%. For ROE industry is 17.9%. Okay, this one is the summary of the profitability analysis. The profitability ratios for BW have all been falling since 2005. Each has been below the industry average for the past 3 years. This indicates that COGS and administrative costs may both be too high and a potential problem for BW. Note this result is consistent with the low interest coverage ratio. And then we move to summary of ratio analysis. Inventories are too high. Maybe paying off creditors or account payable too soon. COGS may be too high. Selling, general, and administrative costs may be too high. Okay, then common size analysis. Common size analysis is an analysis of percentage financial statements where all balance sheet items are divided by total asset and all income statement items are divided by net sales revenue. Net sales or revenues. The example, basket wonders common size balance sheet. This one. This one from year 2005 until 2007. Assets, yeah, cash, inventory, and etc. Yeah. This one is total asset in 2005. This one is 2006, 2007. And this one is common size. For common size, balance sheets items are divided by total assets. So here, for cash is 148, 148 per this total asset. So 12.10%. Ya. Jadi semuanya dibagi dengan total asetnya. This one is from 322 per 1,223. It's also the same for 2006 and 2007. And for the component of liability and equity, so all here divided by total liability and equity. Yeah. This one is common size for income statement. For income statement, so all component here divided by net sales. Yeah. Gross profit, for example, here 386 per 1,235. So the result is 31.3%, etc. Okay, finally we move to index analysis. It is an analysis of percentage financial statement where all balance sheet or income statement figures for a base year equal 100% and subsequent financial statement items are expressed as percentage of their values in the base year. This is the example. So here 2005, yeah, is the base year. So the index rate is 148 per 148 multiple 100%. Yeah. The result is 100%. How about in 2006? 100, yeah, 100 per 148 multiple 100%. So the result is 67.6%. How about this one? This from 410 per 283 multiple 100%. So it becomes 144.9% and etc. It's also the base year is 2005. You can also change if the base year is 2006, so you need to divide all with the base year in 2006 based on the component, which component, yeah. For this one example of indexed income statement of basket wonders. Okay, I think that's all of my explanation. Thank you very much for watching. See you.